Welcome to DACM Insights, where we explore the intersection of traditional wealth management and digital assets. Whether an institutional investor exploring digital assets or a wealth advisor helping clients understand this space, you'll get practical insights from leaders who are actively managing real money in both traditional and digital assets, and the entrepreneurs building the disruptive tech that drives the space so exponentially. Today we're diving into wealthy families and how they adopt crypto and Bitcoin more specifically. We're joined by Tim Whybourne, who's been on this journey for a number of years and has been a trailblazer in bringing this new asset class to his high net worth and family office investors. We want to explore how they approach that decision, how they approach the allocations they make within their portfolios, and how they manage the volatility that the asset class brings to their portfolios. Pleasure to have Tim Whybourne on the podcast today. Tim, thanks for joining us.
Thank you, Richard. It's always a pleasure.
You've had 20 years helping high net worth families navigate financial markets. It's been a pretty interesting 20 years to have that role. You've seen the rise of a bunch of new asset classes, new way of investing, things like private equity, things like hedge funds come along through that journey. And now you've dealt with probably the most different of them all, which is crypto. I think what would be really helpful to understand is, how have you approached that challenge of getting your head around, and particularly your client journey of about understanding crypto and then thinking about allocating a portion of their portfolio to this new asset?
Yeah, it's interesting question. I think if this was 20 years ago, that probably wouldn't have occurred to me. That's just not where I was in the journey. So I started out as a stockbroker, and our mandate, or what we were doing for clients, is literally just talking about Australian equities, and even international equities at the time were pretty exotic. So we were considered thought leaders by even talking about buying kind of Apple and Google at the time. So to make that leap into Bitcoin 20 years ago would have been kind of unheard of. Obviously, our offering has evolved over time, and the industry's evolved over time and matured. I think, private equity and venture capital is probably a baby step into the space. But what we've seen and what we've noticed is what we're witnessing is the birth of an asset class in crypto and Bitcoin. So the last time we saw the birth of an asset class was kind of 20 years ago, when I think it was Macquarie pretty much led the institutionalization of infrastructure, or the ability to put that into a private client portfolio. And 10, 15 years ago, even infrastructure wasn't really that accessible for the mums and dads or the types of people or the families that we manage money for. The ticket sizes were still kind of tens of millions. So slowly we've seen that evolve to the point now where private equity has been democratized. So the entry points are a lot lower. And I think digital assets really are an extension of that. So I see digital assets, Bitcoin, Ethereum, Solana, they're the three big ones. And there's tens of thousands or hundreds of thousands others below that. The best way to describe it is venture capital. So it's liquid venture capital. And venture capital is a frightening space, because even in traditional venture capital, the risk of loss of capital is more than half. So the traditional model is if you invest in 10 venture capital companies, you'll lose money in 20 or 30% of them. You'll get your money back in the middle, and maybe you'll make your money out of 2 of them. So I think you can probably take the same approach, or even probably even less are going to make money in the crypto space, given there's so many tens of thousands. But it really is liquid venture. It can work in people's favor or it can work against them. So the best thing about venture capital, traditional sense, is you're locked in. You can't sell if you wanted to. So your emotion doesn't get in the way. I think the problem with crypto is that your emotion can get in the way, because you can sell it immediately. And that's great for a manager like yourself, who's sophisticated and can pivot in and out of positions. But when it comes to private clients, it puts forward a different problem, in that they can be their own worst enemy. It's great. It's really exciting that we're seeing the birth of this new asset class, and it's slotting in nicely to client portfolios. But we still really are in the early days of education and how to approach this space. And it's more important than ever to partner with someone like yourself, or if you take a step back and get even bigger picture, someone like ourselves that can help clients understand where it does fit into a portfolio without taking a stupid amount of risk.
Yeah, I think you mentioned an interesting point there. I think through my journey of investing across multiple sort of what I'd say is volatile asset classes, illiquidity can be a feature, not a bug.
Yeah, exactly.
Because a lot of the time, the biggest challenge, I think, in making big or outsized returns is actually holding your nerve through those periods, right? And volatility can be that test of conviction. That sometimes illiquidity means you don't have to actually take that test. So do you find with your clients, they actually use illiquidity, or do they learn that lesson as well, and kind of, to use the old term, kind of bottom draw their crypto and just let it be that sort of piece of the portfolio where they're trying to get that long-term asymmetric return?
If we're talking about a crypto specifically here and volatility, we are very clear. We make sure we're crystal clear before we even talk about making an investment into something like a Bitcoin or Ethereum or a crypto fund, that this will be your most volatile asset guaranteed. And depending on the asset, like expectation of outcomes could be anywhere from 0 to kind of 10, 20 X. No other asset class has that return profile. So it really needs to be a position. It's a position that we spend most time talking to clients about expectations and what could happen. And 0 has to be considered there. So we spend a lot of time talking about how that would make someone feel if that investment went to 0, and what amount of money in the broader scheme of things is enough to be able to make a difference to returns in the long run if it goes well, but also not so much that if it does go to 0, which is a possibility. I think it's less and less for something like Bitcoin these days, but if we're talking about kind of the smaller projects, it is still very much a possibility that it's not going to derail the wealth plan over the long run. So we spend a lot of time coaching people about that. I'd say probably don't come in volunteering, but that's how they want to do things. Like no one really comes to us and say they want to put that whole portfolio into Bitcoin. It's something that we kind of try to educate people as an option. And then if that leads to further discussion about possibly making an allocation, then there's a further discussion about sizing.
And what's the natural progression there? So you sit down with a high net worth family that either say, I've never heard of Bitcoin, or they've got some headline that's turned them off. What's the typical progression from that phase to then making an allocation to it as an asset class? What gets them, how do they educate themselves? And what have been the things that generally get them across the line?
Yeah, so we've been pretty proactive over the last kind of 5-6 years looking at Bitcoin and crypto assets for clients. I think my own kind of thoughts or my own positions aside, we were introduced to the asset class in Cathie Wood's ARC portfolio. So Cathie Wood is one of the leaders in disruptive innovation investment in the world, in my belief. It's a very good investor. She had an allocation to Bitcoin, probably one of the first institutional allocations in the world also. So our clients got exposure to that probably 7 years ago. That was in a discretionary portfolio. So they had no choice but to buy it, but they saw it in there. At that point, the ride was pretty strong. I think probably did nothing for kind of 2 years, but then all of a sudden just absolutely took off. So, and they started noticing this position in their portfolio. Long story short, we then moved away from that particular portfolio, and we were left with the decision: do we hold this asset, Bitcoin? It was a Grayscale Bitcoin Trust at the time, or do we sell it? And the decision ended up being that we keep it. So clients ended up holding that position, and it ended up being over the next couple of years like the largest asset that they owned, purely because of the performance. So from that, people started talking about it and doing their research, and a lot of them had a good experience in it. So I wanted to talk about buying more. That led us to talk to new clients about whether or not we should also make a new allocation to Bitcoin for those clients. At the time when Bitcoin was kind of $10,000, $20,000, no one was really talking about it as a serious asset. We were presenting it to people as a potential something that we could put in portfolios and just trying to do the education. But even ourselves at that point, it was very much a speculative asset. So it wasn't something that we were heavily pushing. It hadn't been de-risked. It was just, if you like investments like venture capital, maybe you should have a look at Bitcoin, because Bitcoin is very much like liquid venture capital. We found we got a lot more inbound requests as the price goes up. So it's funny. People won't buy it at 10 grand, but they'll buy it at 100 grand. Because it's been going up for the last kind of 3 or 4 years. So, and it's still very much driven by news flow. So if we start seeing Bitcoin spoken about in the news or, the dinner table, we'll definitely get more inbound inquiry and clients asking if we can put it in their portfolios. And that also led us to take it a lot more seriously and start to look at some institutional solutions to holding Bitcoin in portfolios, with the view that if they're going to do it themselves anyway, we may as well help them to make the best decision that they can possibly make within the space and be with the best managers in the space, driven by flow and price. And it's the polar opposite of how you should approach it. We internally within our firm, we get excited when the price drops. We nearly want it to drop, because we're so convicted in this thesis that it's heading towards $1 million plus over the next 10 years, that if I can buy it cheaper than I could today, that's a win. And then when that happens, we're actively talking to clients about, okay, let's make an allocation, or maybe increase your allocation, or look at something else. I'll still be buying it at $150,000, $200,000, $500,000. I think I stole that from Michael Saylor. It's we do have conviction in the thesis, and it's from the client side. Inbound inquiries driven by price. We're more driven fundamentally. We believe in the technology, and if I can buy cheaper than yesterday, I'm very happy to do that.
Well, you mentioned there, things like headlines, price action, those sorts of things that drive inbound inquiries. One of the things you've spoken about before is, local, very established, very, very household name in Australia, AMP, one of the biggest traditional wealth managers, insurance companies in the Australian market. For our offshore listeners, household name here, like a Franklin Templeton or,
Yeah.
or something of that sort of league. When they disclosed they bought Bitcoin and that became public, you suggested that was a line in the sand. What did you mean by that? And did you see that sort of inbound inquiry off the back of someone that's seen as so traditional and conservative taking that move?
Nobody saw that. I couldn't believe nobody saw that. Anyone I told that, it was news to them. So it was hidden in the back pages somewhere. Yeah. So it was a line in the sand.
Conspiracy theory, Tim.
I've been in big institutions, and I know that how they approach asset classes like this, and it just doesn't make them comfortable. And that they have perfectly good reasons. But we're in a different position. I consider ourselves lucky to be able to talk openly on this topic with clients. But it was a line in the sand because I know that institutions, family offices, big endowment funds around the world, it's been on the agenda for the last 2 years, and no one's been comfortable enough to pull the trigger. Because if you're the custodian of the money and you're voting for Bitcoin, there's not really that much upside for you, like as the custodian or the voter. It's not your money, so you've got no upside, and you've got the downside of getting that decision wrong. So that's nearly a conflict in itself. I think there should have been a smaller allocation a lot longer than that, because had you actually asked the beneficiaries of that money if they were happy to make a 0.01% bet on Bitcoin, they would have all said yes. Zero, it's not going to move the dial at all. So, and that's all that they did. So it's a line in the sand because they finally decided yes. And I think off the back of that was probably 6, 7, 8 months ago. There's been a couple more super funds jump on. So there you go, that line in the sand, they're all jumping over because one did it. Now they're all doing it. And we're seeing the Harvard endowment, their biggest single position is Bitcoin. It's bigger than, their fourth or fifth biggest position. It's bigger than Google or Apple in their portfolio. So there's another line in the sand. But it's we're just getting institutions more and more comfortable to speak about it. And that's very much been driven, I think, by the US president and the whole crypto ecosystem over there. When you got US states talking about accumulating Bitcoin, you got US government itself or the strategic Bitcoin reserve. Every day that there seems to be an incremental positive piece on Bitcoin or Ethereum come out that wasn't there yesterday. And in itself, like, they don't necessarily move the dial. Like, who cares in the scheme of things if one small Australia super fund decided to do it? But it's indicative of what else, the broader movement going out there. And if we get enough of these things happening, which we do every single day, it'll eventually move the dial, and starting to see that in the price today. So woke up today, Bitcoin's nearly back at its all-time high again.
I mean, it's an interesting point you raise that you have this conservative asset allocation decision-making process, which is, put in place for a reason. But they're often making asset allocation decisions, particularly when you start looking at sort of superannuation funds and those sorts of things, for much younger investors that are, starting their working journey, sort of, 19, 25, 30-year-olds, that would be much more open to taking, educated allocations to higher risk assets. And you see that sort of generational divide, particularly with crypto, that you probably haven't seen to another asset class. Does that play through at the family office and high net worth space as well? Do you see the sort of matriarch pushback, yet the younger generations, the positive one, and the advisor on the side skeptical? How does that dynamic work at the larger family offices that are looking at the asset for the first time?
It's all very different. So the family office market in Australia is very fragmented and nowhere near as sophisticated as what I think a lot of people would assume it is. And the actual term family office is probably bastardized a bit as well. So, I don't know how many true family offices there are in Australia. I would define a family office as kind of probably $500 million plus. To be able to get true economies of scale. What's the point? Yeah, it's very different. Family office are family office for a reason. They're not institutions. It's not run by corporates. It's run by families, and every single family is different. And that's a product of the type of business that they grew up, the type of family that they grew up in, and how many stakeholders there are, how many kids do they have, what generation it is. So they're all completely different. We've seen everything from family office have kind of 20, 30% allocation to Bitcoin because they made a decision 7, 8, 9, 10 years ago, and it's just grown and they haven't sold it, through to not ready to pull the trigger yet. So typically your property style family offices not as willing to make an investment into crypto as what your tech entrepreneur might be. So really depends, but yeah, obviously younger generations are a lot more comfortable with Bitcoin and crypto than the older generations. And we've had plenty of discussions that have just been about making an allocation to Bitcoin, which have been squashed by the older generations. But I've also been surprised at times by older generations' willingness to look at this asset class. So there's no hard and fast rule. It really is, each family is so different, and their decisions are going to be governed by their own experiences in life and their risk tolerance at the end of the day.
Has crypto been the most divisive asset that you've ever spoken to your clients about? Like, do you get the same pushback about hedge funds or infrastructure or anything like that?
Yeah, 100% it is. I was very careful about who I spoke to it about probably 7 years ago, because like I remember making posts on LinkedIn about crypto, and all these keyboard warriors would jump on and tear me down, and I've got no desire to argue with someone on a public forum. I just see that completely pointless. And when I see people argue on a public forum, I just think they're both idiots. So I don't bite back, but it kind of was the sign of the times, and everyone's got a very strong opinion. So I used to preface every discussion with crypto by saying, this is the most divisive thing I'm going to bring to your attention today. And we're not telling you to do this, but we do want it to bring it to your attention because we do think it's a good investment opportunity. But this is our advice. You don't have to actually do it. So it's, it used to be very divisive. It's becoming less and less so. And again, just driven by price. So for everyone saying that it's a stupid idea from when it was like $10,000 and now it's 117,000 US dollars, it's getting harder and harder for them to keep that argument. And I'm starting to see a lot of people just falls, like a lot of people that would traditionally have said that it's a silly investment, or it's too risky, or it's it's for criminals. Like they're all starting to see why that may not be the case.
Do you think does reducing volatility help there? I mean, we've seen Bitcoin go from like triple digit vol to 30 vol, or is 30 vol still just way more volatile than anything that it doesn't visually make that much difference?
Yeah, it's definitely helping to increase adoption. It is still the most volatile asset that we own. You could probably argue that venture might be more volatile, but it's just less liquid. Yeah, so you can't see it. So it's the most visibly volatile thing that we own. But the less volatility, the lower the volatility, the easier it is for investment committees and family office types to become comfortable with that asset. I guess the downside of that is with less volatility, you actually get less upside as well. So less downside and less upside. Gone are the days, I think, of the making a 5x in a day. Now I think most targets I see are between kind of a 30 to 45% compound return annually, which is, if you could get that in a listed equity portfolio, you'd be absolutely ecstatic. But it's funny, in crypto land, people still don't seem satisfied, which is ridiculous when you say that out loud.
Yeah, there's a lot of PTSD in crypto, right? So I think one of the interesting things about crypto is I've always found it a relatively balanced market, and it seems to hold it, right? Like it has terrible, violent years, but it generally rewards those that keep the faith.
Yeah.
With the right upside to justify the downside. So
Yeah.
it would make sense that those returns are a little less going forward, of course, as you start to see, the chances, as you said earlier, the chances of Bitcoin going to zero are probably zero.
Yeah.
The return profile sort of sharpens up a little bit. I wanted to ask you a couple of sort of sharp and quick questions, if I can, Tim.
Sure.
When you're talking to someone about the virtues of owning crypto in a portfolio to a skeptical client, how do you pitch it to them in sort of 60 seconds?
It's actually impossible to do that in 60 seconds because it took me probably, 40 or 50 hours of reading for me to get my head around it. So there's no way you can do it in 60 minutes. But I just start by saying, like, what is your issue with it? Do you believe in gold? And the answer is often yes. Like, you have to believe in gold. If you believe in gold, it's not too much of a quantum leap to believe in Bitcoin, because there's a fixed supply of gold, or pretty much a fixed supply of gold. And gold is the value of gold. It's not because it's a pretty thing that we wear on our around us or around our as bracelets. It's because it's a speculative asset. We dig it up, we melt it down, then we put it in a vase and we put it back in the ground, which sounds really stupid. Bitcoin does that job better. And at some point, people made a leap of faith to store value in gold, which is a rock. So once you make that same leap of faith that you can store it into a digital asset, it's not that hard to get your head around why the price should increase incrementally.
Yeah, I think the parity with the goal analogy is clearly the most powerful. I think when talking to Bitcoin, I found that through my journey talking to investors as well. You spoke about getting attacked by the keyboard warriors on LinkedIn. What's the one thing that you wish your peers, your other advisors understood about crypto and Bitcoin that they missed today?
Well, it's probably back to that. Like, if you don't understand Bitcoin, you just really need to get your head around that digital gold thing. But I think the other thing that we hear all the time is that it's for criminals. Well, if you actually believe that, then you haven't done any reading on Bitcoin in the last 5 or 6 years, because you're much more likely to be prosecuted if you commit a crime using Bitcoin, you're much more likely to be prosecuted using Bitcoin than you are cash. Cash is pretty easy or untraceable. First, Bitcoin, completely traceable. So it's not for criminals, which is something people still believe to this day. But it's also just to open your eyes, like listen to the news flow. Something good comes out on the crypto ecosystem every single day. And if you're not paying attention, you will be left behind. You haven't missed the boat. So I wrote an article on that probably a month ago. A lot of people think, oh, it's gone to 100,000. How much higher can that go? Well, the answer is infinite. But I remember looking at Apple and Google 15, 20 years ago. We were selling that for clients at the time because they'd just done like 30 or 40% that year. And I thought, my clients have made really good money here. Like, what do I buy? There's no way I can buy this. Had I bought Apple or Google, I would have made 20 times my money by now. So be patient. We're not looking for a 10x overnight. I think if you can do a 30 to 40% compound return in Bitcoin or crypto assets every year, you're going to more than 10x your money every 10 years. That's 100x over 20 years. The opportunity here is to not stuff it up. It's that's the underlying message. You haven't missed out. This really is just the beginning.
And we've spoken a bunch about Bitcoin, and I know you follow the broader space as well. What are the trends you're seeing in crypto? Not at specific coin level, but what are the trends you're seeing? I mean, you sit in the financial services sector, right? So, what are the trends you're seeing coming over the next 5 years that sort of put crypto in a sweet spot to kind of attack broader and bigger markets?
Yeah, so Bitcoin's one thing that's the easiest to get your head around. That's just digital gold. But then when you look at something like Ethereum or Solana, they're real technologies that real businesses are using to produce real money, which I think people don't really understand. So it's just like the rails to facilitate real business. And a cracking example is news that I saw recently is that the NASDAQ in the US is looking to tokenize every single share to make that share, so whether it's Google or Apple, tradable 24 hours, 7 times a day, and settlement times go from 2 days, which they are currently, down to 0. So instant transfer of cash and ownership of those stocks, 7 days, 24 hours a week. That's a real use case that people just really don't understand the opportunity there. And that's absolutely huge. And that's just one tiny use case, which could be an absolute game changer for the value of that network. And to give an idea of how, if they did that on Ethereum, like Ethereum derives its value from use. So the more transactions that are going through Ethereum, the more valuable that token is going to be. So that's a no-brainer to me. That's a huge piece of news. It really didn't budge the price of Ethereum at all. I was like literally before this interview, I had a client in here today who's a commodity trader, and he was talking about solving for that exact same piece, like how inefficient the trading of commodities is. And he was saying, well, I think the only way forward is to tokenize the whole ecosystem. And he was talking about the derivatives of that and how that would make, second and third derivatives even more efficient also. And I'd never really thought of that use case either, but that's a no-brainer for it too. Like, I really don't think people understand the opportunity that's in front of people and the revolution that's happening right in front of our eyes, which makes it an even better opportunity. If we don't see this, like the rubber hit the road, that's probably the best analogy. I think the wheels are really spinning going at 100 miles an hour, but the rubber just needs to bite in. And I think when we do see that bite, it's going to move pretty quickly. And whether that happens this year, next year, 5 years, 10 years, I don't know. I think it's going to happen.
Well, as a fiduciary managing other people's money in a 24/7 volatile asset class, you sometimes be careful what you wish for. You can have your Sundays ruined by crypto, unfortunately. I do think that's a compelling use case. It's the utility, but it's also, financial services isn't exactly a growth business, right, at the big end. And if you listen to people like Robinhood, I think they make 10% of the costs for a crypto trade of an equities trade, right? Yeah. And so even if you go from it's not growing the market, but if you're removing 90% of your cost base, that's an amazing, compelling thing for a big old institution that's got pretty stagnant top line growth. So it does seem inevitable we start to attack that cost layer with crypto. And I agree, these are massive markets, right? That just make the, I guess the risk profile of the whole asset class look much different to anything that I've sort of lived through over the last 7 or 8 years.
Yeah, 100%.
Tim, it's been awesome that you could join us today. Really differentiated perspectives from a client base, and congratulations on being early to the space and getting your clients to understand it and the returns they would have made from their portfolio of taking that risk after your advice. So very glad you could join us today, and thanks for sharing your perspectives.
No, thank you. It was a great discussion. I really enjoyed it. So thank you.
Thanks, Tim. Thanks everyone for listening to DACM Insights. If you found this interesting, please sign up to receive our weekly newsletter, and there'll be more of these coming as we look to introduce more projects that we find interesting across the crypto space to all of you.